Hi, I'm Claus Vogt with Money and Markets TV. Many people have become complacent about the world around them. When it comes to investors, complacency often means rising optimism about the stock market, which translates to rising equity prices. Conversely, falling prices generate stock market pessimism. This trend alone is not a justification for bearish or bullish strategies until it reaches an extreme. I track stock market indicators that measure sentiment very closely, and today I want to focus on two in particular that are sending bearish signals. One of the most important sentiment indicators is the cash level of mutual fund managers. 40% of all US stocks are held by mutual funds, so their buying and selling can really move the market. Fund managers are as prone to the herding instinct as any other group, which leads to an interesting pattern in their investment behavior. Historically, they hold relatively high cash levels near market bottoms and relatively low cash levels near market tops. In other words, when fund managers are the most bearish about stocks, the market is likely to rise. And when they are most bullish, it usually marks an excellent selling opportunity. This was exactly the case in March of 2000, at the height of the tech stock bubble, at exactly the time when they should have been taking profits off the table. Mutual fund managers were at their most bullish, holding just 3.7% of their funds in cash. For their shareholders, it was a disaster, but for astute investors, it was a very profitable sell signal. This is important because now mutual fund cash levels are even lower than they were back then. According to the Investment Company Institute, they are at just 3.5%. They've been that low only twice before, in the summer of 2007 and in March and April of 2010, and both times the market fell sharply right after that. But this time, cash levels have been extremely low for more than a year. This tells us that the only thing driving the market higher is the Fed, and we don't doubt its ability to continue printing money. But the history of this indicator suggests that the next vicious bear market may be lurking around the corner. Another indicator I follow closely is the Investors Intelligence Advisory Sentiment. This gauge tracks the attitudes of investment newsletter editors. They seem to be more flexible than fund managers at adapting to changing market conditions. So when they are overly bullish as a group, it often has only short to medium-term bearish implications, but long stretches of extreme bullishness in this indicator tend to mark major tops. That's exactly what I'm seeing now. A high degree of bullishness has lasted for nearly 4 months, and the percentage of investment newsletter editors who are bullish on the market topped 55%, the trigger line for a bear market warning. Add to that the ominous news coming out of Japan, North Africa, and the Middle East. These are all clear warning signs of an imminent stock market top. But most fund managers and investment newsletter editors are ignoring these signals. When there is so much complacency among investors, it's historically a major sell signal. If you want to profit from this coming bear market, I think a bet against the Nasdaq 100 is a smart play. So consider buying the ProShares Short QQQ ETF in the $33 to $34 range. This inverse fund is designed to rise 1% for every 1% drop in the Nasdaq 100 index. I'm Claus Vogt with Money and Markets TV, and thanks for watching.